It's game over, Fed. You lose. I'm your host, Steven Van Metre. Thanks for joining me today. And now the Fed finds itself powerless to stop what's coming. Let's pick this story up where we head over to Bloomberg, who headlines that the U.S. job gains accelerate while wage growth slows sharply. The unemployment rate falls to 3.8%, close to the pre-pandemic lows, and the Fed is now likely to remain on track for a Fed lift off in the federal funds rate. The non-farm payrolls increased 678,000 last month, the most since July, after upward revisions in the prior 2 months. A Labor Department report showed today the advance was broad-based across sectors. The unemployment rate edged down to 3.8%, and our average hourly earnings were little changed from the prior month. And here you can see how close we are to full employment. Now on this chart, it says you can notice this gap here, but we're really close. We're just a few million jobs away. And from the Fed's perspective, they believe this is going to heat up even more. In a matter of months, we're going to close that gap and then move even higher up, which is exactly what they're looking for and puts them in position, well, they have to hike. Let's keep going, because while Fed rate hike later this month was a foregone conclusion before payroll data, the report reinforced a recent central banker's assessment that the Labor Department is extremely strong. Employers have added at least 400,000 jobs each month since May against a backdrop of rapid bounce back in the economy. And Friday's report showed average hourly earnings were little changed in February and up 5.1% from a year ago, which actually slowed from the prior month, a deceleration. While hours worked picked up slightly, the disappointing wage data are even worse after accounting for faster inflation, with price increases outpacing growth in compensation. That effectively means many workers are taking a pay cut. So what's the story of why we're all seeing wage growth start to flatten out? Well, because people are coming back into the workforce, and now all of a sudden the employers have choice. They have people wanting to work, whereas before they needed people to work and they had to entice them with higher and higher wages. Now, they're not having to do that. It's a sign that perhaps all this fiscal stimulus is being drained out of accounts and people are headed back to work. Let's keep going, because the labor force participation rate, the share of the population that's working or looking for work, ticked up to 62.3%. And that's good news. And the rate for workers 25 to 54 rose to the highest level since March 2020. Again, as a sign, people are coming back into the workforce. While improved, a combination of factors like childcare challenges, COVID-19 concerns, and early retirements have whittled down America's workforce. Before the pandemic, the overall rate was over a percentage point higher. And here you can see the labor force participation rate moving up in blue. Well, one thing that's got me interested is the monetary base, which is the Fed's balance sheet shown inverted, is headed lower. In fact, the Fed's balance sheet needs to close this gap, suggesting the Fed's way behind the curve and not only needs to end a lot of their remaining emergency programs, but needs to unwind their balance sheet quickly, because the risk here is during the next recession, which may be closer than we think, means the labor force participation rate comes crashing back down to where the Fed's balance sheet is. Let's continue on, because in testimony to lawmakers on Wednesday, Powell noted the decline in labor force participation is certainly something that's now contributing to wage inflation. In fact, that's their concern, is there's going to be further wage inflation that's going to lead to even more inflation because there aren't that many people participating in the workforce. But you know a great way to get people back into the workforce? That's right, a stock market crash will certainly do that. And let's continue on, because something is now contributing to wage inflation and actual inflation and to the labor shortage that we're currently seeing. He said that the U.S. is at least at maximum employment, defined at the highest level that's consistent with price stability. So again, forcing the Fed now to be in a position to act, and that puts them also in a position to not be able to react to what's coming. As Powell said, it's, quote, "It's important for us to be careful in the way we conduct policy simply because things are so uncertain, and we don't want to add to that uncertainty." And he's absolutely right about that, because one wrong move here, which they're going to make anyways, is going to send the economy right back down into recession. And if there's something you shouldn't be uncertain about, well, that's your portfolio. Be sure to check out Portfolio Shield. I'll put a link in the description below and up in the corner. You'll be glad you take a look. All right, let's continue on. The New York Fed's Williams supports March rate hike despite uncertain outlook, according to the Wall Street Journal. Again, we're committed to bringing inflation back down to 2%, says the New York Fed president. More rate increases will likely be needed after this month, and the Fed will also need to lower the size of its balance sheet, according to Mr. Williams. But he added the high levels of uncertainty that made worse by Russia's war in Ukraine limit how much guidance the Fed officials can provide because, well, they need every excuse to not over-tighten here, but, well, they're going to anyways. And so what is it the Fed can't stop from coming? What are they going to be powerless to combat? Well, that's the next recession. And check this out, because we can see that every time you see these big moves in this consumer price index, and there's 9 of them here, you'll notice there's these gray shaded bars. And what does that indicate? A recession. How about crude oil? When you see peak spikes in crude oil or crude oil prices get too high, well, triggers a recession. Almost had one here in 2015. You maybe remember that, but now look, higher crude oil prices, well, that's going to lead to a recession as well. And tack on the dollar, and we see big moves in the dollar. And what is the dollar trying to do here as it heads higher? And remember, the story has been that the dollar is going to weaken and go much lower, but it's going higher because financial conditions are tightening. That's what crude oil is telling us. That's what the inflation data is telling us, is that financial conditions are tight. And because the market doesn't want to release them, the dollar is going to go higher until something breaks. And as the dollar goes higher, well, there's something else that goes higher too, and that's deferred dollars or bonds. So look for interest rates to also go down as the dollar goes higher. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provides educational information only. It's not intended to provide investment or advice. You don't have to be construed as recommendation or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity, opinions expressed in this video that do not affect the view of Atlas Fund Advising or Steven Van Metre Financial.